kindly ask you to mute your microphones during the presentation. If you want to ask questions during the Q&A, please write your name and organization in the chat, and we'll return to you. An alternative is to send an email to investorrelations@tdc.dk. We will do the Q&A after the presentation. I have with me today Group CFO Lasse Pilgaard. Lasse will present the highlights of the quarter and then continue to take you through the performance of the group, TDC Net, NewDay and DKT Holding. Then we will open up for the Q&A session. And now over to CFO Lasse Pilgaard.
Good afternoon and welcome to TDC and DKT Holdings Q3 2020 conference call. Thanks for attending the conference today. I can see we're a little bit less than 80 people on now. If there's any issues with the sound or anything like that, please write in the chat so that we know what is going on. Alternatively, you can also unmute yourself, but we're going to try and control the mutes a little bit from our side to make sure that there's not too much noise going on. So I'll start with page 2. We'll present the highlights from the TDC Group in Q3. In Q3, we saw an improvement in our commercial performance across all main products, as well as continued cost savings resulted in a stabilized EBITDA development with a year-over-year development of minus 0.8%. Year-to-date, that translates into a decline of 2.2%, and we still expect a flat to slightly declining EBITDA development in 2020, as communicated back in August when we came out with our updated guidance on the backside of COVID-19. In Q3, we continue to see good progress on our infrastructure investments across Denmark. The fiber rollout has run in full speed, and again in this quarter delivered more than 28,000 fiber homes passed, bringing the total homes passed to over 80,000 in 2020 alone. Also, the mobile swap reached a significant milestone in TDC Net, having upgraded more than 3,100 out of the total 3,900 mobile sites as part of the nationwide upgrade and preparation for 5G. This has already resulted in a significant improvement in the network quality, both on 4G, but of course also enabling 5G. TDC Net was officially the first MNO that launched 5G in Denmark, which happened on the 7th of September. And NewDay also became the first service provider to bring 5G to Denmark. And as of today, NewDay continues to be the only company that can deliver 5G on the Apple iPhones. In third quarter, NewDay managed to stabilize the market share development significantly across the main products. This came on the backside of some very difficult quarters in Q4, Q1 and Q2 of this year. This was achieved through a number of different strategic measures across the business, which I'll come back to in more details later, but mentioning one of the important ones is the launch of the mobile brand Easy. Easy complements the current mobile offerings from UC and Telmore by offering a simple mobile product at very competitive pricing, but that is still on Denmark's best mobile network. So going after the customers that is not interested in buying handsets and services on top, but are willing to pay a little bit and choose selected on a high mobile network quality. Further, NewDay also launched UTV, which is a flexible TV and streaming service that enables customers to combine their favorite TV channels and streaming services in one app, offering easy and flexible access to be entertained via mobile phone, smart TV, and Chromecast as in the fixed packages. The big difference is that this is really born out of being an aggregator of both fixed channels and SVOD services, but starting with a more, you could say, smart-based platform, e.g. the phone, the TV, the Chromecast. We're also going to talk a bit about COVID-19 today. So regarding COVID-19, the effects on TDC Group's financial performance in Q3 2020 related mainly to the reduced roaming profits experienced in NewDay. In Q3, we of course saw lower traveling activity on business customers as well as lower revenue from tourists. This shouldn't be a surprise to anyone, given also how our peers have reported their numbers. As for our commercial performance, we are currently not seeing a direct impact from COVID-19. Customer payment behavior has not been significantly affected yet, and this is due to the comprehensive COVID-19 packages from the Danish government. However, of course, we continue to monitor our payments closely, as well as the general development in the economy. With that, let us turn to page 3, where you'll get the TDC Group financial highlights. In Q3, reported revenue decreased by 5.3%, which is an improvement when compared to the previous quarter's growth. Challenges towards our customer base development on TV and derived effects on other core products have stabilized to normalized levels. The revenue decrease continues to be mainly driven by a decline in TV and some decline in internet and network, and a bit in mobility and services as well, but where a majority of that decline is due to roaming effects. EBITDA decreased with 0.8% as mentioned earlier in Q3. This is triggered mainly by the decline in internet and network, TV, and to a lesser extent, mobility services. As you'll see later, the decline was somewhat offset by cost savings. And on that, we saw an opex decrease of 9.8% in Q3, or equal to 133 million Danish kroner. This is, of course, a very satisfactory result that we have been able to achieve during the year. The improved operating expenses were fueled by strong cost-saving activities in NewDay following their enterprise agile transformation, as well as many smaller initiatives in TDC Net. This also shows that despite the recent commercial headwind and current COVID-19 impact, TDC's focus on efficiency supports the stabilization of EBITDA. Lastly, capex for the period increased with 16.9% to 1.3 billion Danish kroner, primarily driven by the mobile swap and our fiber investments. The COVID-19 situation has not hindered our investment strategy significantly in Q3, and we are on track on everything. I'll return to this on the next slide. On page 4, we check a little bit more in details into opex and capex developments. So as mentioned now, we decreased our operating expenses by 9.8%. To give a little bit more color on where those were realized, we did see quite a lot in NewDay, by far the biggest contributor to this, but also I would say in TDC Net, we did see quite a significant reduction in both internal and external spend. Of course, given the commercial headwind we've also seen lower external spend related to e.g. marketing and lower subscription activity costs. But it's important to say that cost savings is fairly strong in our DNA and will also continue to be that in the future, which is not necessarily different from many of our peers that is focusing the same way. The improvement is also, I would say, fueled by the fact that the separation of TDC is progressing according to plan, and the costs and temporary dis-synergies related to the separation of TDC are ramping down. And I think we've talked about these investments previously, and of course for the last more than a year, 5 quarters, we haven't significantly invested in the separation, but it's clear that some of the dis-synergies that arose from having done the separation, we are now systematically also trying to decrease again in this phase of our transformation. Just touching a bit more on capex. So in Q3, the capital expenditures totaled 1.263 billion, an increase of 16.9% compared with the same period last year, which is in line with our expectations and plans. In 2020 is a year where we upgrade our network to 5G and expect majority of associated capex with the upgrades to be realized within this year. Further, we continue our fiber rollout strategy as we see great potential in extending our future fiber footprint. We're still working hard in investing in splitting and renewing our critical IT landscape so that NewDay and TDC Net have the best possible foundation as independent market players. These programs are also going according to plan. So all in all, we would say that our larger capex investment programs, as I mentioned earlier, have not been affected negatively by the COVID-19 situation. Turning to page 7, we check in on the financials of TDC Net. Revenue in TDC Net declined by 3.1% in Q3 compared to the same period last year. This was mainly driven by declines in TV and landline voice, and the TV part was due to a phase out of the legacy service provider on TV called MitTele. And of course, the landline voice decline is a continued trend that we have seen for a long time. On internet network, revenue decreased due to customer decline on DSL, which was partly offset by ARPU increases from an improved customer mix with more fiber customers. Revenue in mobility service increased in Q3 year-over-year due to increased traffic. The revenue decline combined with an improved gross profit margin led to a gross profit decline of 2.3%. The operating expenses in TDC Net declined by 8.4% in Q3 year-over-year, driven by lower personnel expenses, and this is despite a 6% increase in total FTEs, which is part of the increase in capex due to the efficiency improvement operations and high capitalization of personnel expenses. especially, of course, driven by the increased investments in fiber and 5G, as well as lower costs related to the separation of TDC Net. Despite the GP decline, the opex improvements created that we managed to increase the EBITDA by 1.3%. On capital expenditure, TDC Net continued to invest in fiber rollout with more than 28,000 homes passed in the quarter and swapping the mobile network to 5G, where TDC Net has upgraded over 3,000 mobile masts so far. In addition, investments related to customer installation increased due to high gross adds on coax and fiber. All in all, capex increased with 42.4% in Q3 year-over-year. Let's now turn to page 9, where we'll go through NewDay products and performance in Q3. As mentioned earlier, NewDay saw a significant improvement in the commercial development in Q3, and as a result, the market share development across our main products were almost flat compared to end of Q2. Flat on TV and mobile, and small decline in broadband, as I'll get back to. So starting with internet and network, gross profit in Q3 decreased by 1.3% in consumer and 7% in business. The main driver was declining customer bases in both segments compared to the same period last year, but in business we also saw some ARPU pressure. The RGU development in Q4 of 19, Q1 of 20, and Q2 of 20 plays a large role here, as customer losses improved in Q3 compared to the three previous quarters. The negative development was partly offset by higher ARPU in consumer due to price increases and speed upgrades. Our NewDay broadband market share came down to 42.1% in Q3 compared to 42.8% last quarter. And this was primarily driven by migrations away from DSL to fiber, and specifically fiber where NewDay does not yet have a live integration to sell on their infrastructures. And this is of course the utility company fiber, where we are in a process to get NewDay on to sell on their infrastructures, but due to many different reasons, among others, that regulation has been a bit slow, and this has not been possible until recently. On mobility service, gross profit decreased by 5.3% year-over-year in consumer and 2.2% year-over-year in business. The decreases were driven by declining customer bases and lower business ARPU, only to some extent compensated by the improved trajectory in Q3 from e.g. the performance of our new brand Easy. COVID-19 also impacted roaming negatively, and this too has a negative effect on gross profit, as I mentioned earlier. An effect that partly offsets the negative gross profit growth was an increase in the consumer ARPU due to price increases. On a positive note, and despite losing customers in our consumer division, we managed to increase our mobile revenue market share marginally in Q3 year-over-year, and measured on RGU market share, we saw a development from 39.1% in Q2 to 38.9% in Q3. In our TV business, gross profit declined by 3.2% year-over-year in Q3, which is driven by the decline in customer bases. The impact from the customer loss in Q4 of 19, Q1 in 20, and Q2 in 20, of course, carries a run rate effect into the Q3 numbers, as the RGU net add development improved substantially in Q3. The gross profit margin was improved in Q3 on the back of the price increases on a range of legacy TV products, as well as a lower level of content costs compared with the same period last year. Even though content costs in Q3 were lower compared to the same period last year, we continue to pay attention to the inclusion of streaming services in our TV packages, as that is margin dilutive, investments in content, and our own TV channel C, as these investments serve our vision of delivering first-class entertainment and flexibility to our customers. Despite also having launched a new and very exciting TV offering called UTV, which is, I mentioned, is really born from the smart platforms up, we did experience a small decline in the overall TV market share in Q3, going from 51.3 to 51.1. This is not a reflection on the performance of UTV, but of course UTV wasn't launched until the very mid of September, and hence the numbers are of course not included in this. And on that note, before anyone asks me if I can share any numbers on that, that's of course too early to do, and it's also very much a long-term bet we're doing with UTV. It's not a temporary reaction to anything in the market. Lastly, landline voice. The landline voice gross profit declined by 16.4% year-over-year in our consumer division and 8.3% in business. The main drivers declining customer bases in both segments. On page 10, we're checking on the financials of NewDay. Revenue New Day declined by 6% in Q3 year-over-year. This was driven by revenue declines on the back of lower customer bases compared to the same period last year. The decrease in customer bases was partly offset by higher ApS in both consumer mobile and internet and network. This was primarily driven by price increases and speed upgrades, respectively. The revenue declines can, to a large extent, be contributed to the extraordinary high losses of customers in both Q4, Q1, and Q2 of this year, and these declines will carry a run rate effect into the following quarters. However, the development in customer bases have improved, as I mentioned, to the end of Q2 and Q3. The revenue decline was the main reason for the 9.7% decline in gross profit in Q3. Lastly, the operating expenses in New Day saw a quite significant drop compared to the same period last year, and as I mentioned, New Day is the main contributor of the strong performance for the group. Overall, New Day managed to improve the operating expenses with 13.6% year-over-year in Q3, which is quite impressive. In Q2, New Day implemented a new operating model for Enterprise Agile, and the transition of the organization continued into Q3, leading to a further reduction of personal expenses and thereby improved performance in operating expenses. So this is, of course, the main contributor, but there's been many other small initiatives also running during the year. Further supporting the positive development were also, of course, as I mentioned, reductions in acquisition costs and lower marketing expenses. So all in all, these events led to an EBITDA decline of 2.8% in Q3 year-over-year, which is 15 million lower than Q3 of last year. A development that overall we're not satisfied with, but of course we are happy with the improvements we've done into Q3, especially given the uncertainties and the challenges we had in Q1 and Q2. On capital expenditure, we realized a saving of 26.1% in New Day year-over-year in Q3. This was driven by lower costs related to IT investments in privately owned networks and customer installations. On page 12, you can see the DKT Holdings financial highlights. So all operating activities relate to TDC's activities. Accordingly, EBITDA and capex largely reflect TDC's corresponding figures. The loss for the period was negatively affected by interest rate expenses on DKT's debt. I think I don't have a lot more to add on this. On page 13, you find a leverage table for the TDC Group and DKT Holding. So TDC's net interest-bearing debt of loans, bonds, and cash was 20.2 billion and respectively 30.8 billion at DKT Holding level. Liabilities due to mobile spectrum and effects from IFRS 16 on leases were 6.6 billion Danish kroner. So looking at the developments, leverage at TDC AS, excluding effect from spectrum and lease obligations, decreased with 0.1x to 3.6 from June 2020 to September 2020. The leverage at DKT Finance Group was 5.4 times EBITDA. So summing up, in Q3 20, we saw an improvement in our commercial performance across all main products, as well as continued cost saving, resulting in a stabilized EBITDA development in Q3 with a small decline of 0.8%. So year to date, we are seeing an EBITDA decline of 2.2%. And as we communicated in August, we are still expecting a flat to slightly declining EBITDA development. And of course, one of the main reasons for this is if you look at last year's Q4, which had some one-offs dragging it down and higher content cost, we do expect a fairly positive Q4 in terms of the current run rates. So with that, I'll pass it on to Henrik Jorsø Nielsen, who will moderate the Q&A session. And please, I know there were a little bit of confusion at the last meeting on how do you actually ask questions. You need to go to the chat, which has this small bubble in the top, and then write your name. We tried to illustrate it here on the slide, and then we'll take the names and questions as they come on the list, and ask yourself to unmute when we call your name.
Okay, so thank you very much, Lasse, and